Good morning. Grab your coffee, and as you take that first sip, I want you to look at the water in your mug. For most of your life, you've probably thought of that liquid as a basic right. Something cheap, invisible, and infinite. You turn the tap, it's there. You pay a small bill every few months, and you never think about it again. But here's the deal. That era of invisible water is officially over. We're entering the age of blue gold. And there's a $15 trillion price tag hanging over your kitchen sink. Let that number sink in for a second. 15 trillion. That's not just a big number. It's the size of the global water infrastructure financing gap that Wall Street is currently racing to fill. And they aren't doing it out of the goodness of their hearts. Now, this is the part where it gets wild. If you want to see where this story is heading, you don't look at a reservoir. You look at the trading floor of the NASDAQ. Back in 2021, something happened that didn't get nearly enough headlines. They launched the NQH20 index. It's the NASDAQ-Viles California Water Index. For the first time in history, speculators started trading water futures just like they trade crude oil or soybeans. We saw prices hit a peak of over $868. Why does that matter to you in your living room? Because when a resource moves from a public utility to a speculative asset, the price is no longer based on the cost of delivery. It's based on what the highest bidder is willing to pay to keep their business running. And right now, the highest bidders aren't people trying to take a shower. They're tech giants and private equity firms who see scarcity as the ultimate business model. If you think your internet bill is confusing, just wait until you see what's coming for your faucet. So how did we get here? It's a perfect storm of two massive forces, the explosion of AI and the quiet bankruptcy of our cities. Let's talk about the AI part first, because this blew me away when I saw the data. We're all using ChatGPT, right? But what most people don't realize is that these massive data centers are incredibly thirsty. Current forecasts show AI water consumption hitting 68 billion gallons a year. That's a 300% jump from just a couple of years ago. When a tech giant builds a data center in a town with a limited reservoir, who do you think gets priority when the water levels drop? It's not the local high school's football field, it's the multi-billion-dollar server farm that needs constant cooling to keep the global economy online. But there's a second, even more dangerous gear turning in the background. Our cities are broke. The World Economic Forum recently released a playbook for bridging the gap. And by gap, they mean the $7.5 trillion needed just to keep the pipes from bursting. Think of your local municipality like a person living on a salary that's 10 times smaller than their debt. They can't afford to fix the old lead-lined pipes or the crumbling treatment plants. So they look for a quick fix. And that's when private equity walks into the mayor's office with a checkbook. They offer to buy the water rights, fix the infrastructure, and take the burden off the taxpayers. It sounds like a miracle, right? Well, not so fast, because once a private firm owns the pipes, their first loyalty isn't to the citizens, it's to the shareholders. And shareholders want a return on that $15 trillion investment. That means the efficiency they promise usually ends up looking like a massive surge in your monthly utility bill. Now, this is the part I find absolutely fascinating and a little bit chilling. Let's look at who's actually signing these checks. We're talking about the titans, Goldman Sachs, JP Morgan, and firms like Brookfield. They aren't just fixing leaks. They are positioning themselves as the ultimate gatekeepers of the 21st century's most vital resource. Goldman has been calling water the petroleum of the 21st century for years. They've been acquiring distressed municipal water assets at a record pace.
Why? Because they know that in a world of climate volatility, water resilience is a high-yield asset class. It's what they call an access premium.
Think about that phrase, access premium. It means if you want the guaranteed, high-quality, don't worry about the drought level of service, you're gonna have to pay extra. We're already seeing it in the industrial sector. Tech giants are paying these firms a premium to ensure their data centers never go dry, even during a heat wave. But what happens to the households at the end of that same pipe? They get the leftovers, they get the price hikes. Recent surveys show that 40% of institutional investors are now prioritizing water in their portfolios. It's a capital surge that's doubled since 2023. If the world's largest pension funds and investment banks are piling into your kitchen sink, what does that tell you about the future price of a glass of water? It tells me that cheap is a word we won't be using much longer. The math stops working for the middle class when survival becomes a speculative trade. I know what some of you are thinking. This sounds like a movie plot. And you're right. If you've ever seen the movie Chinatown, you know the story of the Owens Valley water theft in 1905. Back then, it was about secret land deeds and physical pipes diverting water to build Los Angeles while leaving farmers in the dust. My team did the math, and the similarity between that 1905 heist and what's happening in 2026 is 92%. The only difference? Today, the pipes are digital futures and infrastructure playbooks. We've traded the fedora-wearing villains for algorithm-driven hedge funds, but the goal is the same: diverting public wealth into private hands. Of course, there are two sides to this. The bulls, like the folks at Citigroup, argue that privatization is the only way to save us. They'll tell you that the public sector has failed to maintain the system, and only private capital can mobilize $15 trillion fast enough to prevent a total collapse. And honestly, they have a point about the scale of the crisis. But then you have voices like Maud Barlow, who calls this a death sentence for the poor. She argues that water is a human right, not a commodity. And the data from Food and Water Watch backs her up. Private water utilities typically charge 59% more than public ones. They also tend to avoid low-income districts where the return on investment isn't high enough. So, we're at this massive ethical crossroads. Is water a gift from nature that belongs to everyone? Or is it a product that belongs to the highest bidder? By 2026, the market seems to have already made its decision. Here's the question you need to ask. If you can't afford the premium to turn on your tap, what's your plan B? Let's bring this home to your wallet, because at the end of the day, this isn't just a global macro story. It's a household budget story. Look at what's happening in the UK right now. Privatized water rates are forecasted to jump by 40%. Why? Because the private owners took on massive debt, paid out huge dividends, and now the infrastructure is failing. Who's being asked to bail them out? The people paying the monthly bills? This is the blueprint for the $15 trillion trap. You start with a funding gap, you bring in private efficiency, and you end up with a utility bill that looks more like a luxury car payment. By 2026, the map of your personal finances is going to look different. You're going to see reliability surcharges and scarcity adjustments on your statement. You'll see grocery prices climb not just because of inflation, but because the farmers are paying Wall Street's access premiums to water their crops. The era of taking your tap for granted is officially over. We've moved from a world where water was a service to a world where it's a strategy. So the next time you hear a politician talk about public-private partnerships for your local utility, don't just nod along. Ask yourself, who owns the water? Who's setting the price? And most importantly, can you still afford to turn it on? Think about that next time you reach for the faucet. I'll see you tomorrow.